Operating Officer, Dr. Srinidhi Parthasarathi, beloved Principal, Dr. E. Jerome Xavier, and dear participants. A warm welcome to you for this national webinar on impact of revised accounting standards in corporate sectors. Indian Academy Degree College is one of the prestigious institutions in Bangalore. Indian Academy Degree College has been sanctioned academic autonomy as prescribed by UGC. It offers UG and PG courses in science, commerce, management, and humanities. We have 17 undergraduate courses and 14 postgraduate courses, and we are in the top 50 B schools in our country. With this small introduction, I call upon Professor Jafar Mohammed to welcome the gathering.
Most respected Chairman, the Chief Operating Officer, the Principal of our college, the guest speaker and the resource person, the head of the department, distinguished participants of the webinar, members of the staff, and the participating students, ladies and gentlemen. Exclusiveness of mankind over the ages has been to overcome the challenges posed over time. Indian Academy Degree College Autonomous has been in forefront in organizing a series of, rather a plethora of webinars, both national and international, from last 6 to 7 months. This is necessitated due to the change environment where knowledge transfer has to be through virtual and online mode. This webinar is part of the sequence of virtual learning exercise carried out. We in the Department of PG Commerce is organizing national webinar on the topic Impact of Revised Accounting Ind-As in Corporate Sector. We have with us today as a resource person, Mr. Lakshmi Narayanan, Senior Chartered Accountant, faculty member and corporate trainer, and above all, veteran resource person in various conferences, seminars, and faculty and executive development programs. It is with immense pride I would like to present before you the brief profile of our distinguished resource person and guest speaker. Sir has the professional qualification in chartered accountancy, and he's been a seasoned practitioner in his profession. His love for interacting with the students, he has been a proactive teacher in various institutions. He has been a trainer in the Indo-Asian Academy for Training and Development. Sir has been an active resource person in various institutes, like he's an empaneled trainer with Dale Carney, India, empaneled teacher and trainer with St. Joseph Evening College, empaneled speaker with Seshadipram Group of Institution for motivational, soft skill and finance related subject training. And his corporate clients include Maruti Suzuki Limited on behalf of Dale Carnegie India, Lubin Labs on behalf of Dale Carnegie India, Solaris Pharma USA, Dampathy Pharmaceuticals USA, Ucal Private Limited, Technosoft Private Limited. And likewise, he has a list of institutions where he had been a resource person, like Christi Jayanti College and St. Joseph College Autonomous, and so on and so forth. I, on my personal behalf and behalf of our institution and the head of the department and all of us from the institution, like to extend a warm, hearty and cordial welcome to you, sir. I welcome all the distinguished and honorable dignitaries, our chairman, sir, our chief operating officer, and the principal, Dr. Jerome Xavier, other staff, both present with us and also who are not with us today for various reasons and in absentia for the support. I welcome all the participants, both faculty members and students, and welcome all the other supporting staff for the background support. Well, about the seminar, an accounting standard is a common set of principles, standards, and procedures that define the basis of financial accounting policies and practices. Accounting standards improve the transparency of financial reporting in all countries. Business is highly dynamic, so how accounting standards is also. Ind-As impacts also changes. Changes in Ind-As is bound to impact much more on the corporate sector. To know more about it, let's listen from our chief guest speaker, Mr. Lakshmi Narayanan, Senior Chartered Accountant and Corporate Trainer.
Thank you, sir, for that wonderful introduction. Over to you, CA Lakshmi Narayanan.
Okay, are you able to hear me clearly?
Yes, sir.
Good morning to everybody. Respected Chairman, Chief Operating Officer, Principal, and Head of the Department, dear faculty members and students. I would first like to start with a joke on chartered accountants. Actually, once a teacher asked, "What is 2 plus 3?" A student said it is 5. Then he went to a chartered accountant and asked the same question. He replied, "What do you want the answer to be? If you want 2 plus 3 is equal to 5, I can make it. If you want 2 plus 3 is equal to 5,000, I can make it. If you want 2 plus 3 is equal to 5 lakhs, I can make it. I can make anything what you want." That is how the financial statements in most companies are prepared without having regard to any principles. So we had accounting standards in order to arrest this trend of preparing accounts as you like. Then each country has got its own accounting standards. 192 countries are there recognized in UN. 192 local GAAPs were there. So it provides for a very cumbersome preparation, conversion to local GAAP when an operation is having multinational presence. So all the world community thought together and introduced what is called IFRS, International Financial Reporting Standards. And all the member countries, all the 192 countries are members of the institution which promotes IFRS. So each country has to amend their GAAP, local GAAP, to conform to the standards of IFRS. Many companies actually follow IFRS itself. For example, Indian operation of most multinational corporations, they follow a more stringent operation, stringent IFRS. Now, Ind-As is developed as an answer to the requirement of having to comply Indian standards with IFRS. Therefore, it gave rise to Ind-As. So even with Ind-As and AS, one of the complications that chartered accountants face is the pressure from the top management to present figures as they want. Because CEO nowadays are under tremendous pressure to comply with the quarterly results also. So they pressurize the auditors. But however, we will study about Ind-As today and what changes it has been made. Usually, a PPT is open and presented to the audience. But I follow a different procedure. I will share my screen and open a plain Excel sheet in which I am going to take you step by step. Because if I open a PowerPoint, the attention goes to the PowerPoint. The 5 points that I am making is missed. But when I am writing it in an Excel, like writing it on the board, people follow what I write. And so this is the technique that I have learned in Dale Carnegie India, the leading corporate trainers of the world. Dale Carnegie was the first corporate trainer. So I'll just share my screen, just check whether my screen is visible. Where you see Excel sheet? Hello?
Yes, sir. We are able to see your Excel sheet.
Very good. Thank you for the confirmation, because I can go on and on without confirming, but if you don't see the Excel sheet. So what is the Ind-As financial statement has? Ind-As financial statement consists of a balance sheet, a profit and loss, cash flow, then notes on accounts. Then we have statement of significant policies. Statement of significant policies. This is what we had before the Ind-As and Companies Act came. Now, this is before Ind-As. Before Ind-As, and it is accompanied by a director's report, auditor's report. Right? This is what we had. Ind-As introduced two things. One, profit and loss. Under Ind-As, we split the profit and loss into one, statement of profit and loss. I'm not going very technical because of the diverse audience that we have, but my aim is to make the audience at least prepare profit and loss and balance sheet and appreciate the finer points. Profit and loss and statement of comprehensive income. This is what IFRS demanded. So that should, in the we used to have one profit and loss. Now it is split into statement of profit and loss and statement of comprehensive income. We will see what is statement of profit and loss and statement of comprehensive income. And then it compelled us to have another statement called statement of changes in equity. Statement of changes in equity. Sorry. This is newly introduced by Ind-As. All listed entities and all entities with net worth less than 250 have to follow Ind-As. That is the applicability of Ind-As, newly introduced by Ind-As. Now, Now, let us revert to the format what we had before Ind-As. So, I'm just tracing the profit and loss account format changes given by Ind-As. For that, there are not much changes in profit and loss. The changes are in balance sheet. So before we used to prepare what is called, this is the format of profit and loss account, revenue from operations. This used to be the format, other income, total income. You may be aware, but I'm just refreshing your memory. In expenses, cost of materials consumed. Differences, changes in inventories. Then we had employee benefits. Then we had depreciation. This is the minimum requirement, and other amortization. Then we had other expenses. This is what we had, and total expenses is the addition of all expenses column, and then we had profit before extraordinary items and exceptional items. So this is nothing but total income minus total expenses. Then comes extraordinary items, then exceptional items. This used to be the format before the introduction of Ind-As. Profit before tax. Profit before tax. Now, what are the changes that profit before tax, then tax? Tax, we put it as current assets, current tax. 2 is the deferred tax. Then we minus tax, we come to profit after tax. This is what we used to have, plus this is actually profit and profit after tax. Then we will have profit or loss from discontinuing operations. Right? This is what we used to have. Now, what are the changes that is introduced by Ind-As? It introduced the profit and loss account is fine. You also have to say statement of other comprehensive income. This is newly introduced by Ind-As. What is that? We will come to that. I will explain, I will take you through this. But before that, first item is sales. Before the introduction of Ind-As, in order to window dress the accounts, window dress the account means I am not having enough profit, but I have to report certain amount of profit to my board and to my shareholders. But my profit is not enough. What the CEOs used to do, is to create a number of invoices as on 31st March. Increase the sales. This is the favorite form of window dressing. Another form of window dressing is to increase the stock, closing stock, thereby reducing the material consumed. These two are the favorite window dressing techniques by the top management. Now, Ind-As has produced stringent test in order to put this in the revenue from operations. If you have to book in revenue from operations, it is not enough if you have delivered the goods to your customers. It says you can book in sales, only if the risk and reward has passed on to your customers. So, what does this mean? When does the reward passes on to your customer? Not when he receives the goods, but when he can lawfully use it and derive profit from it. Give you an example. The example is you are selling machinery to your customers. When he can lawfully use it, not when he receives it, but when he has installed the machinery, when he has tested the test production is what we call. When he has tested that the machinery can work according to the specification, then only the reward is passed. Usually what companies do, they actually dispatch and immediately put the sales invoice, right? Even now people do it, but according to Ind-As, you cannot do that. You can do only when the customer has received. In respect of big machineries, it takes 6 months to install the machinery. It takes another 3 months of test production, right? Then only you can book. So this is what is prescribed by, that is reward passing on. The risk also has to pass on. When the risk passes on, it depends upon the price conditions. As you are aware, the price is FOB, free on board, FOB. We have free on board. Means you have dispatched the goods and placed it on the truck or the ship or the air, which means you are transporting. Then the risk passes on when you place it on the truck. When you have actually dispatched and placed it on a truck to be taken to the customer, under free on board condition, the risk passes on. Everything that happens to the truck after you have placed it on the truck is the risk goes to your customer. So CIF means there's a CIF. CIF means cost, insurance, and freight. In this case, the risk passes on only when the customer receives the goods. When the customer receives the goods in good condition. This is the test of passing on of the risk. So this is the major introduction of Ind-As. And we used to call another, otherwise most are same. Secondly, Ind-As prohibits any item. Ind-As prohibits any item to be classified as extraordinary items. No item can be classified as extraordinary item. Extraordinary and exceptional items should go to the statement of other comprehensive income. This is introduced by Ind-As. So actually, if companies follow, not only the risk should pass, but also reward should pass. That means your customer has started using your product for his economic benefit. He is deriving some economic benefit from your product. This is the major change in the Ind-As. The other major change is statement of other comprehensive income. We used to club lot of items under other income. Now, whatever we are doing it under other income, it is now coming to statement of other comprehensive item. For example, profit or gain, sorry, profit or loss on forex transactions and forex translation of financial statements. Now, when property, plant and equipment is actually PPE is actually revalued. One of the changes introduced by Ifrs and Ind-As is valuation of each item of assets and liabilities according to fair value. We will see about this when I talk about balance sheet, right? Whenever the asset or liability is revalued at fair value, then there arises a profit or loss. Where will you put that profit or loss? This is the place. Profit or loss on revaluation at fair value. This is the major change, right? There are actually 9 items which should be classified under other comprehensive income. So statement of profit and loss now truly reflects the profit and loss from operation. It doesn't suffer from any extraordinary items or the others are a little technical, kind of information that I'm making. So remeasurement of defined benefit plans. Then gains or losses from valuation of equity instruments. So I hold any equity, I have invested in equity of another company which is publicly listed. Then as on the balance sheet date, I have to revise it to the market price. Yeah, major fair value is a major departure from pre-Ind-As condition. At one point of time, revaluation is considered as a step for window dressing, but not anymore, because IFRS compels that every item on balance sheet has to be revalued whenever you close the accounts and present. That is a major change in thinking, because people used to think, in fact, Companies Act has got lot of restrictions in revaluation before the introduction of IFRS. In fact, if you revalue, then you have to get some permission, and then you have to put balance sheet revalued as on. So you should indicate to the public that you have revalued. but not anymore. Those restrictions are gone. Statement of other comprehensive income, reclassification adjustments. Supposing an item is classified before under profit and loss, now it is taken to statement of other comprehensive income. We call it as reclassification adjustments. So these are the most important things that you need to make. There are certain items which are prohibited to be displayed in profit and loss account in the individual standards. Individual standard says that you should not put this in profit and loss account. Such cases are also put under statement of other comprehensive income. So why Ind-As has prescribed this? Very simple, because it wants to differentiate between operational profit arising from operation and arising from revaluation and other items prohibited to be displayed in the profit and loss account, but which has a profit or loss element. These are the major changes. So the impact on corporate sector is, if they follow Ind-As, then they cannot simply dispatch the goods and then book it in sales, prepare an invoice and book it in sales. They have to see that the risk and reward has passed on to their customer. It also depends upon the individual contract. Actually, Ind-As prescribes a 5-way test to see if it can be classified as sales. Otherwise, you should not take it to the profit and loss. You should say advance from customers. That's all. 5-way test, it is too technical, so I'm not going into it right now. Now, let us go into balance sheet. So, what are the changes brought in by Ind-As? Revenue from operations, that is sales. How it should be classified? That impacts the sales value and therefore the profit or loss of the company for the year. Now, the major changes, and it has introduced statement of other comprehensive income, and it prohibits any item to be classified as extraordinary items. Now we go to the balance sheet. Balance sheet has undergone a very comprehensive change. I will just show you shareholders funds. First, we used to classify like this: share capital, reserves, share capital, reserves, surplus. Total is shareholders funds. Share capital plus reserves and surplus, we used to call it as shareholders funds. Then we used to classify secured long-term borrowings. This is pre-Ind-As, long-term borrowings. In this we will come secured loans, unsecured loans. Then we used to have current liabilities. Current liabilities. We used to classify as sundry creditors under current liabilities. Sundry creditors, other current liabilities. Then provisions is called current liabilities and provisions. That is this is on the liability side, right? And total is nothing but shareholders funds plus long-term borrowing plus current assets and liabilities, right? This is called sources of funds. This is the modern terminology we used. Before we used to call as liabilities, but the modern terms we call it as sources of funds is nothing but liability side of the balance sheet, as you know it. Liability side of BS. Now asset side is called application of funds. We used to have tangible assets. Before we used to call it as fixed assets. Tangible assets fixed assets less accumulated depreciation. This is what we used to have. And net fixed assets. Net fixed assets. Then we used to have capital work in progress. Capital work in progress is nothing but half completed tangible asset or intangible asset. Then we used to have intangible assets. Intangible assets. Then we used to have long-term investments. We used to call it as investments only, but under this we classify long-term investments. Then we have current assets. Current assets we used to have cash and bank, sundry debtors, then inventories, then other advances. Then we used to have preliminary expenses not written off, right? This is the traditional balance sheet format. Now the Ind-As says that it is not enough. This is not enough. You will have to do better. How do we do it better? I'll tell you what is the format is all about. Now, asset side. Let us see first. You have to classify assets, right? Let us go to asset side. This is now called assets, right? Now, it is not enough if you classify it under tangible assets and give figures for gross fixed assets, less accumulated depreciation. In fact, many companies just used to give only net fixed assets and keep a detailed fixed asset schedule in the schedule. In the balance sheet, they used to show only net fixed assets. Some of the good companies, they also show gross fixed assets. Now, assets, how you have to classify? Now you have to classify it like this in the same order. Tangible assets is now renamed as property, plant and equipment. B, capital work in progress. All this should be form part of this. Nomenclature is also changed. This is called non-current assets. This is now called. So you have to classify assets into non-current assets and current assets. Under non-current assets, how we present is property, plant and equipment, capital work in progress, and then investment, long-term investments. Then D is goodwill. One of the changes brought about by Ind-As is If there is goodwill in your balance sheet, you have to specifically put the account goodwill. It has to be classified. It has to be disclosed in the balance sheet. Then other intangible assets. This gives a more complete picture of what is the asset that can be sold and bought in the ordinary course of business, and what are the intangible assets which cannot be that easily sold. Then intangible assets under development. G. Biological assets. What are biological assets? You have got a farm in which you are doing farming. So the farm and other implements are biological assets. So Ind-As has introduced biological assets as a separate classification. These are all introduction by Ind-As. Nomenclature, non-current assets also is Ind-As. Fixed assets, nomenclature changed to property, plant and equipment, right? These are all the things introduced by Ind-As. Otherwise, there's a rearrangement. Then we have got financial assets. So under financial assets, you have investments. Trade receivables for more than 1 year. Less than 1 year will come under current assets. Trade receivables, if trade receivables are due after the current accounting period, 12 months from the closing of the account, then it is classified under non-current assets. Loans, long-term loans. All these are, whenever I classify under non-current assets, it is realizable only 12 months from the date of closing of the accounts. That is the definition. Loans. Others, if you cannot classify, whatever is realized after 1 year. Then current assets. We come to current assets. Why so much? Because the reader, the user of the information, has to see which are all the assets that can be realized in value. That's the reason why it requires so much of classification on the face of the balance sheet itself. Current assets is again inventories. Financial assets. There is financial assets in non-current. There is financial assets in current, which means those financial assets which can be realized less than 1 year is called current assets. For more than 1 year is called non-current assets. So in financial assets, we have got investments, trade receivables, then we have got cash and cash equivalents. Under bank balances, loans, others. So you will have to classify like this: inventories. Under financial assets, you have got investment, trade receivable, which you can receive within 12 months from the date of closure of your balance sheet, cash and cash equivalents. Cash and cash equivalents, the definition has changed. How it has changed? Bank overdraft is considered as cash or cash equivalent under Ind-As. Before bank overdraft, we can move around. I can take a view and say it is long term. I can take a view and say it is short term. Right? If my current assets to current liabilities ratio, which is called liquid ratio, is not favorable, I will move bank overdraft from current assets to long-term loans. But now bank overdraft has to be accounted under cash and cash equivalent, which is one of the important changes in India. So you cannot move around and make a favorable current assets to current liabilities ratio. That is one of the changes. The second change, cash and cash equivalent, includes instrument, financial asset, which is realizable within less than 3 months. For example, liquid funds. Within 3 months, you can encash it. So that liquid mutual funds can also come under cash and cash equivalents. So those investments which you can realize within 3 months from the date of closing of the balance sheet, you can classify it under cash and cash equivalents under Ind-As. So bank balances, this is the, and then comes deferred current tax assets. Then you have to classify current tax assets as a separate heading. What is this? This is advance tax paid. Advance tax paid. Advance tax paid, TDS receivable. This is called current tax asset. Then you have other current assets. This is how this simple balance sheet in the asset side is now, you see, detailed, right? So this is how we actually classify under Ind-As. The important change, fixed assets is named under property, plant and equipment. Biological assets is introduced in Ind-As, before it is not there. Then financial assets, we have to classify investments, trade receivables, loans and others. Second important thing, it is divided into non-current assets and current assets. In non-current assets is one category and current assets is another category. So it compels the companies to inform the details of their assets so that the user of information can find out which is a fictitious asset and which is a realizable asset. This is the major change, because the disclosure here, disclosure is everything, right? So under financial assets include investments, trade receivables, cash and cash equivalents, banks, loans and others. Before we used to have cash and bank as a separate category, inventories as a separate category, trade receivables as a separate category. Now everything comes under financial assets, right? On the liability side, how are we faring? Now, balance sheet liability side, the share capital is renamed as equity share capital. So only equity share capital can be classified as share capital. Before we used to have equity capital plus preference share capital plus the balance of convertible instruments, whichever has become due for conversion. All these three we used to show it as share capital. No more. Now we have to show equity share capital separately, and there is reserves and surplus is also taken out. That is called other equities. So we display what is share capital and what is other equity. Other equity means it is preference share capital plus preference share capital plus reserves and surplus. This both is called shareholders funds. Nomenclature change. So people know what is the actual equity share capital, because that is the only ownership that we have. Preference share capital also has got a part of ownership, but not full ownership. And then what we have is non-current liabilities. It is a counterpart. Non-current liabilities. I'll quickly finish it. Now under non-current liabilities, you have to have financial liabilities. What are they? There also, there is express classification. There also, you have to give lot of classification. What is those classifications? One, borrowing, long-term borrowings. Under non-current liabilities, any liability whose dues are becoming payable after 12 months from the date of closure of your balance sheet. Then trade payables. Trade payables is nothing but sundry creditors. Long-term trade payables. Then other non-current, other financial liabilities not covered by this. Then we have got provisions. It is the same as. Then we have got deferred tax liability. Before we used to show this liability just after the shareholders funds. Deferred tax liability is shown here. But now it should be listed under non-current liabilities as the fifth item. And 6 is other long term is replaced by the word non-current. Then we have current liabilities. Under current liabilities, again we have got financial liabilities, which is short-term borrowings. Trade payables. This is short-term trade payables. Before we used to have all trade payables under current liabilities. We never used to distinguish between long-term current liabilities and short-term current liabilities. And then we have got provisions. Then we have to show provision for current tax liability. These are the items. You will have to split the current liabilities into financial liabilities and provision for current tax liability. And provisions for bonus, provision for dividend will all come in this. So what is the objective of Ind-As? The companies have to be more transparent and fair in giving information to the public, especially public listed companies. And they have to give such details that would enable a user of information to take a fair decision. Who is the user? Number one, shareholders. They have to find out whether they can continue to invest in the business or whether they should sell off this share. Second, prospective investors. Third, creditors. Fourth, customers. And fifth, the general public. Sixth is employees. All these people, unless they get a very good information base, they cannot take a informed decision. So Ind-As compels the companies to be more transparent and fair. Of course, there are other aspects like disclosures, which I have not gone into because it's too technical and cannot be covered in 1 hour that is allotted to me. So this is the balance sheet format, and this is the profit and loss account format, and the changes that is introduced, especially sales as a means of window dressing has been taken away by Ind-As. Similarly, inventories as a window dressing tool has also been taken away because there is a lot of disclosures, lot more disclosures required under Ind-As compared to pre-Ind-As. Well, these disclosures are what policy you have taken, why you have taken the policy. Both you have to explain. Before we used to have that we use in preparation. Now it is not enough. The disclosure requirements go far beyond. You have to state the policy in detail for each and every item of profit and loss and balance sheet, and also state reasons why you have selected this policy. And you have to be consistent as in like. So I end this at 11:58 and I open the floor for questions. I can stop and just stop sharing my screen and coming back to the chat window. Is there any doubts that we have? Because by design I have kept it very simple. I have highlighted the various changes so that it caters to the diverse audience.
So thank you so much for your way that you dealt with the topic. Now I will hand over the floor to CMA Arshad Ullah Khan to take over the Q&A session. So over to you, sir.
Thank you, Sam. Is my voice audible?
Yes, yes.
Yes, sir.
Sir, thank you for that wonderful session. In an hour, you have explained us the basics of income statement as well as balance sheet. Thank you so much, sir. Otherwise, we should have spent hours together understanding the nuisance of this new format and the old format and the differences in a very, very lucid language. You have made us to understand these two formats. Thank you so much, sir. I request participants to ask questions in the chat box so that I can reframe, and if there are similar questions, I can put to sir so that he can give us clarification. Sir, meanwhile, I have 2-3 questions, sir. So, sir, like you said, the major change is from historical costing, we are moving to fair value.
Correct.
So, like we used to value our, let us say, fixed assets. Let us say I have purchased a building for 5 lakh rupees. I used to show every year at 5 lakh rupees.
Correct.
Now I have to revalue my building at the market value, fair
Correct.
value, which is market. And you know, sir, it is like giving a freedom for manipulation again.
No, it is not giving freedom for manipulation, because see, the reader of your balance sheet is a very informed person. So that is why we have 2 statements. One is statement of profit and loss and statement of other comprehensive income. So before, what we used to do, whenever we do the revaluation, we actually will not disclose. So revaluation profit will be a major profit. It will be disclosed in other income. But now other comprehensive income is made. so that we differentiate between operating income and other comprehensive income. So revaluation, profit or loss comes under other comprehensive income. But still, Ind-As gives you two options: to keep it at historical basis for the time being, to keep it at the historical cost, or to keep it at fair value. Both is given. When you are choosing the revaluation method, then any adjustments you make it in other comprehensive income. Second thing, when you are fair valuing your assets every year, the increase is very less. 5 lakhs you might have bought in Malleshwaram about 30 years. Now we are going to suddenly revalue from 5 lakhs, it will go to 500 crores or even 5,000 crores. But every year, if you are revaluing, the increase is only marginal, and it gives the true shareholders funds or true net worth of the company. IFRS compels you, it doesn't give you historical cost basis choice. IFRS compels you to fair value each and every item. Hello.
Thank you, sir, for answering that question. Professor Arshad, could you please
Yes, sir,
ask the next question?
Sir, I think one more candidate has asked, sir, are there any specific checks in IFRS to keep a check on the companies that not to manipulate these fair values?
Yes, that check is actually made by, this check is actually have to be enforced by the auditors. In IFRS, you either 100% compliant, or no, even if you are 99.99% compliant, 0.0% not you are IFRS. I mean, you are not compliant with IFRS. So IFRS compels 100%. AS and Ind-As, the auditors can qualify the statement by saying that you have not adhered to such standards. In IFRS, auditors cannot qualify the balance sheet and profit and loss account. They have to certify that it is 100% in compliance with IFRS.
Okay. Sir, one more question is, like, why do we classify inventory as a financial asset?
What is financial asset? The definition: any asset which can be converted into cash. That is called financial assets. So inventories can be converted into cash. It is going to be converted into cash at one point or later. So that is the reason why we classify inventories as a financial assets. The previous definition of financial assets is equity, mutual funds, fixed deposits, and things like that. Financial instruments. That is not to be confused with financial assets under Ind-As. Previously, financial assets means investments. But now, financial assets include various other things, what I have demonstrated.
Thank you, sir, for that clarification. Sir, like one more question which we keep getting is, like, though we have converged with IFRS, yes, in the form of Ind-As in India,
yes,
we have made a lot of changes.
Correct.
We have made a lot of changes, and now what we hear is that IASB, which is the body controlling IFRS, they are not IASB, yeah,
body controlling IFRS, yes,
IFRS. Now what they are saying, the amount of changes that you have made is not as per IFRS, so we don't agree that Ind-As is IFRS.
Correct.
So
I agree with that because
some type of this is between CA Institute and IASB. So they are telling this is not IFRS. So how do we, after all these efforts that as an economy we are making, the companies that we are making, and even after making so much of changes, and if IFRS is telling that this is not IFRS, then what is the purpose or use of this? Or if they reject, then it is not globally again accepted.
Correct. It's not globally accepted. Ind-As is not globally accepted. Each country who are subscribers to IASB can have two standards. One is IFRS and another is called local GAAP. This local GAAP for India is Ind-As. So the professionally managed companies, very big companies, they follow IFRS straight away because it is the most stringent form of standards. And if they comply with IFRS, that means they have complied with all the provisions for Ind-As also. Converse is not the case. If you comply with Ind-As, it doesn't mean that you have complied with IFRS,
Right, sir, right.
because Ind-As is adopted to local convenience, local trade practices. It is influenced by local trade lobbies. So that is why it is watered down. I told you IFRS compels you to fair value each and every assets and liabilities, whereas Ind-As gives you a flexibility for property, plant and equipments. You can put it on historical basis or you can put it on fair value, but IFRS doesn't give you much of a choice. And the disclosure requirements of IFRS is more stringent than Ind-As. Ind-As is adaptation to Indian conditions, that's it. But it is compliant with 80%, I would say. 70 to 80%. It is compliant with IFRS, but a little watered down, diluted.
Thank you, sir, for your clarification. Sir, I have one more question from the participants.
Yeah, any number of questions I can take.
Yeah,
Don't worry.
thank you, sir. This bank overdraft you were talking, sir.
Yes.
Cash under current assets.
So cash and cash equivalent.
Yeah, earlier we had an option to classify bank overdraft as long term or short term. Now there is like no option. We have to classify. Can you clarify on that, sir?
Yes,
if
actually,
bank overdraft is let us say it's
even
payable after.
Bank overdraft cannot be classified as long-term investments. Why? Because bank overdraft are sanctioned only for 1 year. Every year you have to renew. In which case, as on the balance sheet date, your bank overdraft renewal will fall within the accounting period. So actually we used it for window dressing by interpreting, okay, anyhow I'm going to renew and therefore it's a long term, is what we used to argue. But it is not like that. Even before, if you correctly apply what is bank overdraft, which is renewable every 12 months, means you have to repay within the accounting period and then you can get another new bank overdraft. So for window dressing, we used to have it, but now India says you classify it under one head only.
So there is
the misuse of classification is avoided now.
Thank you, sir. So there is one more question.
Yes.
Is there any special sector in which only IFRS is applicable and local GAAP is applicable? Sector wise, has the government classified, or is it like country wise full?
No, it is applicable for all. They have classified 250 crores as net worth. Any company having 250 crores, irrespective of the setter, net worth of 250 crores has to apply Ind-As or IFRS.
Good. I hope
if your net worth is less than 250 crores, that means you are a small company, then you have the option of adhering to AS. But professionally managed companies prefer IFRS, second preference to Ind-As.
Thank you. Sir, one more, I feel it might be the last question. Sir, sir, this US is a very big economy.
Yeah.
And US companies are across India. Even in India, if you take many of the MNCs are US based companies.
Correct.
But in US, they follow their own accounting standard, US GAAP, not IFRS.
No, you are misinformed. Actually, US big corporation, they have got eligibility for IFRS. Under that eligibility, if you come, you have to apply IFRS. Only small companies use US GAAP. As I have told you, every company can have a local GAAP and IFRS together, because the cost and expertise required in IFRS is too high. So IASP decided it is not fair to tax small companies, publicly not listed companies. Publicly listed companies, IFRS is compulsory in US. The rest of the companies which are small in size or medium in size, they can use US GAAP. Every country has got local GAAP and IFRS. Not only US and India.
Right. Thank you, sir, for that clarification. Sir, one more participant has one more question. 1 minute, I will pose that question to you. Sir, do all Indian MNC companies like Tata, Reliance, etc. make both IFRS and Ind-As?
They
Do they
have the
make
option.
both? Do they make both financial statements, one under IFRS and one under Ind-As?
Not required, because if they prepare under IFRS, then all the conditions of Ind-As is also fulfilled. So they need not prepare two sets of accounts. And I don't think any large companies prepare two sets of accounts, to my knowledge.
Thank you, sir, for that clarifications. I hope our participants have more clarity now. If you have any more further questions, you are welcome to ask participants. Otherwise, sir has, I think, he has given a very clear talk in which doubts should be very, very minimum. I think don't have more. I will check, sir. 1 minute. Sorry. Thank you, sir, for that question answer session. Sam, sir.
Yes, sir. Thank you so much, sir. The way you have answered every question, it's like you haven't even given a second thought. That shows the experience that you have and that that you have learned or acquired over a period of time. Really glad that we had you on this session, sir. So, dear participants, we've come to the last part of this program, that is the vote of thanks. And here I am proposing the vote of thanks to you. Gratitude is a powerful catalyst for happiness. First of all, my gratitude to Almighty God for making today's event a resounding success. On behalf of Indian Academy Degree College Autonomous, I extend a hearty thanks to our chief guest and a wonderful speaker, C.A. Lakshmi Narayanan, who made this an interesting and practical webinar. Thank you, sir, for sharing your knowledge and wisdom on Ind-As. The way you channelized and directed the content was elaborate and yet so easily acquirable. Thank you so much, sir. My heartfelt thanks to our chairman, Dr. T. Somshekar, Chief Operating Officer, Dr. Srinidhi Parthasarathy, Principal Dr. E. Jerome Xavier for providing an opportunity to organize this webinar. My sincere thanks to HOD Dr. Kanti Madhinathan for being the initiator of this program. And I extend my heartfelt thanks to all the faculty members, Department of PG Commerce, for your efforts and inputs, without whom this program would have not been successful. Our special thanks to Chandan sir and his team for providing timely IT support, and to all who have supported, a very big thanks to you. To conclude with, knowledge transfer is complete only when implemented. And I believe that this webinar has enhanced your knowledge. So my sincere thanks to all the participants who are going to implement and who are going to see the fruit of this. Thank you so much, one and all. Have a wonderful day ahead. Please note that we have posted the feedback form link in the chat box. So please do fill in the feedbacks through which you will be receiving the e-certificates. So please do not forget to fill the feedback forms through which you will be receiving the e-certificates. Thank you so much, one and all. Thank you, sir, for your time.
Thank you so much.
Sir, thank you once again, sir. It was a wonderful session. Very nice, very useful.